Welcome to the deep dive. This is where we take a huge pile of research, different sources, and really boil it all down to the essential stuff you need to know.
Yeah, the actionable insights.
Exactly. And today we are strapping in for a pretty fascinating look at oilfield services. We're doing a deep dive into Halliburton Company, ticker HAL.
Right, Halliburton. They're such a key player in the global energy picture. But, operating in that sector, it means dealing with just incredible volatility. So we've pulled together a whole bunch of sources, including a really detailed report from Compasscope, plus recent comments from the executives themselves.
And our goal today, pretty simple actually. We want to get you totally up to speed on HAL's complex business structure, pinpoint their specific market risks, and really importantly, break down the strategy they're using right now, especially with the market softness we've seen lately.
Yeah, it's been a sharp turn.
It has. It's a huge company, so let's just jump right in. What's Halliburton's core identity? How do they actually make money?
Okay, so at its core, HAL is a leading global provider. They supply products and services for basically the entire life cycle of hydrocarbons, finding them, developing the fields, and producing the oil and gas. They touch almost every step.
Global provider, but with a catch.
Exactly. While they do operate globally, and we'll definitely get into that, you absolutely have to remember their, let's call it, operational DNA and their main revenue stream. It's heavily weighted towards North America, particularly U.S. shale. That's key.
Okay, U.S. shale focus. And they structure this whole operation into two main segments, right? These reportable segments. Let's start with the one that sounds like where the big money is. Completion and production, or C&P.
Yes, C&P. That's definitely where the action kicks in after the drilling stops. Think of this part as everything you need to actually complete the well and then keep the oil and gas flowing. And this is really where Halliburton shines.
Okay, so what are the key activities there?
The absolutely crucial line here is pressure pumping. Now, that's the technical term, but what it really means is hydraulic fracturing or fracking. This is typically the highest margin, most tech-heavy part of completing a well. It involves their own special tech, like the Smart Sleet system, and maybe most famously, their Zeus electric fracturing platform, the E-frac.
Ah, the E-frac. We hear a lot about that. That's the stimulation side. What else is under that C&P umbrella?
Well, you've also got completions. That's the actual hardware, the mechanical stuff that goes down hole in the well. And then there's the really important high-margin business of artificial lift.
Artificial lift. Explain that a bit for us.
Sure. So for anyone not deep in the weeds here, artificial lift is basically using pumps like ESP's electrical submersible pumps to give the pressure a boost and get more oil out after the natural pressure in the reservoir starts to fade. It's really essential for getting the most value out of a well over its lifetime. And it's a big growth area for HAL, especially overseas.
Makes sense. Anything else in C&P?
And finally, there are specialty chemicals. These are, fluids and additives designed to optimize production and keep those flow rates up.
Okay, so C&P is all about the advanced tech to make the well produce. Now, what about the other main segment? D&E, drilling and evaluation. What's their role?
So D&E is focused on the front end, finding the oil and gas in the first place, and then actually drilling the wellbore. It's the foundational work, you could say.
And the key parts there.
Key lines include drilling services. This is where they use sophisticated systems like their proprietary iCruise rotary steerable systems for really precise directional drilling. They also handle drilling fluids, those complex mud systems you need to manage pressure and clear out rock cuttings. Then there's wireline and perforating, using tech like Xaminer to basically map out the well, and cementing.
Cementing sounds basic, but I imagine it's pretty critical.
Oh, absolutely critical. You need that well integrity to last for decades. They even develop material science innovations, like something called the Ovidius alloy, just to make sure those cement jobs hold up.
Okay, that gives us a really clear map of the business. Now let's shift to the competitive side, because Halliburton definitely has areas where they dominate, right?
Yeah.
Where are they the undisputed leader?
Oh, yeah. Hydraulic fracturing, period. The research we looked at, including Compasscope, confirms they've got something like 25% of the global frac market share. And they are just overwhelmingly dominant in U.S. onshore shale, that short cycle activity.
And technology is the key.
Technology is absolutely key. There's Zeus, E-frac, Smart Fleet, iCruise. This stuff gives them real differentiation. And it's not just, marketing fluff. This tech genuinely translates into cost savings for their customers, and that lets HAL command better pricing, which in turn fuels their really strong free cash flow generation. They're good at turning tech into cash.
That strength sounds impressive, but like we touched on, doesn't that North American focus create a vulnerability? I mean, 25% global frac share is great, but if half your revenue comes from just one notoriously volatile region,
It absolutely does. That's the flip side. That roughly 50% revenue dependence on the North American short cycle market makes them super sensitive to commodity price swings and sudden shifts in spending by oil companies, which is exactly what we've seen play out recently.
so compared to the other giants.
Well, compared to their main rival, SLB Schlumberger AKL definitely has a weaker footprint internationally and offshore. It just makes them inherently more cyclical.
Okay, so let's do a quick snapshot. Based on the Compass Scope analysis, how does Halliburton compare directly against SLB and, say, Baker Hughes?
Right. SLB Schlumberger is the overall global leader by size. Their big strength is massive geographic diversification. They're much stronger internationally, much stronger offshore, and they've put a huge successful emphasis on digital tech in energy with platforms like DLLFI. Importantly, they're deliberately less exposed to the short cycle U.S. frac market than HAL is.
Okay, different strategy. And Baker Hughes, BKR.
BKR is interesting. They have a broad portfolio like the others, but their strategic focus seems a bit split. They made this very public, very large bet on the energy transition, things like carbon capture technology.
Which could be huge down the line.
Could be. But the analysis suggests that this focus tends to dilute their efforts in the traditional upstream oilfield services, the bread and butter. And in that core business, they generally lag behind both HAL and SLB.
So the takeaway is pretty clear then. HAL dominates the high-margin North American completions game. SLB leaves on global reach and diversification. And BKR is kind of betting the farm on the energy transition, maybe at the cost of their traditional strengths.
That sums it up well. HAL has that immediate tech advantage and pricing power in its core market. But SLB arguably has better long-term stability because they're spread out more geographically.
Right. Stability. That brings us straight to their growth strategy. If they are so concentrated, what are they trying to do about it? How are they looking to grow or diversify?
Well, the strategy is kind of two-pronged. First, maybe counterintuitively, they're actually doubling down on maintaining that North American leadership.
Oh, okay.
By really pushing customers who adopt those high-tech solutions we talked about, like the Zeus eFrac, which offers real cost savings and, crucially, lower emissions for the operators. And the iCruise drilling systems, too. They're basically saying, our tech is superior, it saves you money in the long run, so pay for it, maintaining pricing power through tech.
But what about the diversification piece? Are they actually trying to reduce that reliance on North America?
They are, but it's selective expansion internationally.
Yeah.
They're not trying to be everywhere like SLB. They're targeting specific, complex, high-value projects in places like Brazil, Norway, and the Middle East.
So targeted strikes, not a global carpet bombing.
Exactly. And we had to bring back artificial lift, that high-margin business, growing that, deploying their Intelvid automation platform, especially in Latin America and the Middle East. That's a major focus because those contracts tend to be longer-term, stickier, and less tied to the immediate ups and downs of U.S. shale drilling.
Okay, so when you analyze the strategy, doubling down on tech in the U.S., selective international moves, pushing artificial lift toward, how viable is it? Can they realistically challenge SLB internationally, or is it more about protecting their core?
Well, it definitely offers potential for great near-term profitability, assuming North America cooperates, because that pricing power from Zeus is real, but that geographic concentration risk, it doesn't go away.
Still the Achilles heel.
Still the Achilles heel. The Compass Scope analysis basically says scaling up internationally enough to really offset North American swings will be slow work. SLB just has such massive head start, such an entrenched position globally. So yeah, HAL can make great money when U.S. shale is hot, but their path to stable long-term growth looks, well, arguably tougher than SLB's diversified approach.
That vulnerability takes us right into execution risk. If the strategy relies so much on customers paying up for premium tech and the slow international build-out, what are the big internal risks? What could go wrong with executing the plan?
The main internal risk really is customer appetite. Specifically, their appetite for high-cost technology when the market softens. The whole success of Zeus and iCruise depends on customers adopting them widely. But when commodity prices get volatile, and we know they always do, customers get laser-focused on upfront costs.
Right, they might just opt for the cheaper, older tech.
Exactly. They might resist that premium price tag, even if the long-term economics are better. And if that happens, HAL's margins erode, and that competitive edge dulls pretty quickly.
So how does Halliburton's execution risk stack up against the others? You mentioned the volatility from their North American concentration.
Yeah, overall, HAL's execution risk is probably best described as moderate. It's definitely higher than SLB's risk, just because SLB is so much more diversified geographically. They can weather a U.S. downturn better with strong international contracts.
But lower than others.
But HAL's risk is significantly lower than Baker Hughes, for instance. BKR is making huge bets on the energy transition market, which is still pretty uncertain and, frankly, nascent. HAL is relying on demand for services that are fundamental to oil and gas production today, and their risk is certainly miles lower than smaller players who might be financially weaker. HAL has the balance sheet, they have the tech portfolio to ride out cycles, even if they can't completely avoid the bumps.
And those bumps aren't just theoretical, are they? They're happening right now. We've got fresh insights from their Q2 2025 earnings call back in July. The CEO, Jeff Miller, sounded like he was signaling a pretty rapid shift in the market.
Oh, his commentary was direct. Blunt, even. He said something like the market looked very different today than it did only 90 days ago. That's a fast change, and he pointed to the triggers. Accelerating commodity price volatility, trade uncertainty, and the impact of those OPEC plus production cuts. Management was essentially saying, okay, folks, a downturn is starting, especially right here in our backyard.
Wow. Okay, so let's get into the specifics from that call. What's the actual forecast look like for North America now for the second half of 2025? It sounds grim.
It's a substantial downgrade. Because of all those headwinds, they said multiple operators are now planning meaningful schedule gaps, which is industry speak for idling rigs and stopping frac jobs.
Yeah.
So Halliburton management now expects their full-year North America revenue to actually decline by low double digits year over year. That's a big drop from earlier expectations.
Low double digits. Ouch. And the big strategic response they announced was stacking frac fleets. What does that actually signal to you and for the listener?
It signals discipline. Huge discipline. Stacking just means they're choosing to park equipment, take it offline. If it can't earn the returns they demand, they're explicitly saying, we will prioritize profit margins and returns over just keeping busy or holding market share.
So protect the bottom line, even if revenue takes a hit.
Exactly. It's a deliberate move to try and help rebalance supply in the market by taking some of their own capacity offline. It might hurt revenue in the short term, but it's a strategy focused on the longer-term health of the market and their own profitability. It's actually a positive sign of strong management, even if the reason for it isn't great news.
Any bright spots in North America from the call?
Well, on the tech side, they did confirm that Zeus IQ, that's their intelligent e-frac system, is actively deploying. They expect it to be running on about a third of their Zeus fleets by the end of the year. So that shows tech adoption continues, even when things get tight.
Okay, so North America is contracting significantly. Did the international side provide enough of a cushion to offset that?
Unfortunately, no, not entirely. Even though they saw continued growth in some key areas like Brazil and Norway, the forecast for a full-year international revenue was also revised down, now expected to contract by mid-single digits.
Mid-single digits internationally, too. Why the drop there?
It seems to be driven primarily by specific activity slowdowns in a couple of really large, important markets. Specifically Saudi Arabia, related to reduced activity in the massive Jafurah gas field, and also Mexico.
Jafurah. That's a huge unconventional gas project, right? Why is the slowdown there so significant?
Yeah, it's one of the world's biggest. Any slowdown there sends ripples. It's a concentrated hit for the service companies working in the Middle East, including HAL, and it just shows that even these giant state-backed projects aren't totally immune to broader policy decisions, like those coming from OPEC plus more.
Were there any international bright spots mentioned?
There were. They specifically highlighted growth in unconventional plays outside the U.S., places like Argentina, Australia, other parts of the Middle East. And remember, artificial lift. They confirmed that high-margin business is still on track to grow over 20% for the year. So some resilience there.
Okay, so overall softness, North America hit hard, international contracting slightly. How is management actually protecting the profits amidst all this?
Yeah, they were very clear, laser focus on costs. They're hitting the brakes with immediate, widespread cost-cutting actions, looking at both variable costs and fixed overheads. Trying to right-size the business for the reality they're seeing right now.
And the financials reflected that pressure.
They did. Q2 revenue came in at $5.5 billion, but they noted that C&P margins especially were squeezed by that lower pricing in U.S. land and the slowdown in Saudi. But because of that cost discipline, Their free cash flow outlook for the full year 2025, while revised down a bit, is still projected to be very healthy, somewhere between $1.8 billion and $2.0 billion. So they're actively managing the downturn, not just letting it happen to them.
That discipline response really seems like the key theme for them right now. Okay, let's wrap this up. Based on everything we've discussed, especially that Compass Scope report, what are the absolute most critical things our listeners should be watching over the next few quarters to see how this all plays out for Halliburton?
Okay, yeah. The keys to watch. Let's rank them roughly by importance, drawing from that analysis.
Number one has to be the macro picture, right? The tide that lifts or sinks all boats.
Absolutely. Number one, global oil and gas demand and commodity prices. Simple as that. This drives the spending decisions by the E&P companies, the clients who hire HAL. If oil and gas prices fall significantly, HAL's revenue gets hit hard and fast, especially because of that North American exposure.
Okay, price is king. Number two, then, surely has to be that core market, North American market dynamics.
Exactly. You need to watch for those schedule gaps. Are they continuing? Is pricing pressure getting worse or easing up? And crucially, how quickly does that short-cycle U.S. shale activity start to recover? The timing of that recovery really dictates their immediate profit picture.
Makes sense. Number three.
Number three is about their strategy cornerstone, technology adoption and competition. Keep an eye on how well customers continue to adopt premium tech like Zeus eFrac and SmartFleet. If the market downturn forces customers back to cheaper, maybe older non-electric frac options just to save upfront cash, well then HAL's whole premium strategy starts to wobble and their margins could erode fast. Competitors are always waiting to pounce on that.
Good point. And finally, number four, the potential long-term offset.
Number four is international growth. Can they actually execute on scaling up those selective operations in Brazil, the Middle East, and elsewhere? Can they do it fast enough to provide a meaningful cushion against the U.S. swings? If they can't gain real ground against SLB internationally, they just remain structurally more cyclical, more exposed than their biggest competitor.
So, summing it up, Halliburton is still this technology leader, especially in North American completions. But this recent market volatility has definitely forced management's hand. Their playbook right now seems very clear. Discipline, above all, stack the fleets that aren't making money, and focus squarely on returns, not just volume, through the rest of 2025.
That's the picture. Strong tech, but facing cyclical headwinds and managing through them quite deliberately.
Yeah, and that commitment to discipline, especially the willingness to actually idle profitable equipment to protect margins, that was maybe the strongest signal they sent. It really makes you wonder, doesn't it? Given that management is willing to sacrifice some market share now, how quickly will the fleet reductions across the whole industry that result from this kind of discipline actually rebalance the market? And when will Halliburton start to see the payoff from taking that disciplined stance today?
That's the multi-billion-dollar question for the next cycle, isn't it? How long until that discipline pays off?
It really is. Something for you to think about as you watch things unfold. We'll catch you on the next deep dive. This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.